For Deepwater Asset Management, I'm Gene Munster. The topic today is why Tesla is the winner in the United Auto Workers negotiations. 3 points. First, we're going to talk about what the strike is all about. Second, we're going to talk about the current and future gap between cost per hour of a worker from United Auto Worker unions versus Tesla. And third, we're going to talk about the bigger picture, the transition to electric, and what all this means for that dynamic. And going back to the top in terms of what's at stake, there are several factors here. I'm going to highlight three. First, the wage increase that the United Auto Workers are looking for. They originally wanted a 40% wage increase. They've backed that off to a 35% as of this recording, which is about 12 hours before the deadline. Second is they want a 32-hour work week, also to make more money, that 35% more money, but on a 32-hour work week, down from 40-hour work week. And last, they want protection for those workers that are working in powertrain. That includes engines and transmissions. Those, of course, are going to get upended in the next decade with electrification. Your engine goes away. You still have a form of transmission with a motor, but essentially there's going to be a retooling on that, and people are going to lose their jobs, and they want protection for that, understandably so. But that's essentially what is the dynamic that's at stake. Second is outlining the difference between the cost structure of Tesla versus the big three. And this comes in part from reporting from Axios and the Washington Post, but as it stands today, this is before the negotiations, is the big three pay on average. This includes your hourly wage, pensions, and profit sharing, about $66 per hour. Average Tesla worker is about $48 an hour. As I mentioned, the gap right now is the UWA wants a 35% wage increase, and the big three are kind of right around a 20% at the time of this recording. Let's say it nets out to a 25% wage increase. That would take the overall plan, overall comp plan, again, including pensions and profit sharing, up by about 20%. It wouldn't be up as much as the wage increase. And so if you put that gets the average hourly rate just below $80, $79 to be exact. And so that would put the gap between the big three auto worker per hour and Tesla to be 79 versus 48, which is about a 65% more or less gap. And so big gap there, but that's not where the story ends. When this goes through, when these negotiations end, undoubtedly Tesla is going to want to give their workers a pay raise, or they will want a pay raise even though they're not part of a union. But I'm assuming that there's going to be kind of a 15% pay raise for Tesla workers in the next year as part of this changing dynamic. And at that point, that would put the cost differential between traditional auto and Tesla somewhere between 40 and 45% after everything is said and done. Before all this started, it was about a 37% gap. And so net is it's going to get worse for the big three relative to Tesla when it comes to cost per hour of manufacturing labor. And the last piece, the most important thing, is that traditional auto is in the red when it comes to electrification, and they will continue to be in the red. My belief is for 2+ years. Now, most of them don't give data related to this topic. There's going to be, of course, the initial hit when they announced the strike, and most believe that a 10-day strike is going to cost the industry $5 billion. That's not the really important part. The important part is just the transition to electrification, some of the losses. Ford, again, is the only company that has really given details about their transition to electric and some of the losses. They're expecting this year to have a loss of $4.5 billion. That initially was a $3 billion loss, but they upped that since some of the price wars that have gone on, and some of them lowering the price of Ford lowering the price of their cars. So it's a $4.5 billion. They're expecting to produce 600,000 electric vehicles sometime in 2024, sometime middle of next year. That's about 6 to 9 months behind what their initial target was. So that continues to kind of lag behind. And when you put this together, is Tesla in the June quarter produced about 10 times as many electric cars globally as the big three did in the US. And so there's a big advantage that Tesla has just in terms of production, which obviously creates more efficiency, which is one of the reasons why Tesla is in the black when it comes to making EVs. Kind of a high teens gross margin when it comes to their car business. And as I think about this delta that's going to increase between the cost of labor for traditional auto versus Tesla, that will just further put pressure on this transition for the big three. And it is going to come in the form, manifest itself likely in the form where Tesla continues to keep prices lower, and that continues to keep the big three in the red. And I suspect it's going to be 2+ years, could be even longer, before the big three starts to see some profitability in electric. And I continue to believe that ultimately that some of these car companies that have been kind of the cornerstone of how we've thought about cars for the last 100 years will be a fraction of their size in the future. Which ones are at most risk? Hard to say, but I think that what's going on with the cost of labor is an important dynamic about that transition to EV, and a dynamic that has going to only increase in Tesla's favor in the weeks to come. On behalf of Deepwater Asset Management, I'm Gene Munster. Bye for now.